Yo, what up everyone? In this video, I'm going to talk about the mindset you need to have in order to become a better trader and start becoming more profitable. I'm also going to talk about what some very good traders do, including myself, and relate some examples back to the charts. I made a video similar to this about 2 weeks ago, Mindset of a Profitable Trader, and I promised I'd make a part 2. So let's see if we can break the like count, 762 likes on the last video. Take 2 seconds, drop a like on this current video. Let's try to beat this record. And also, I recommend following me on Instagram at Ameritrade. I'm going to link it in the description below. I post daily trading recaps on here, along with very good trading tips and tricks that I guarantee you're not going to find anywhere else. The link is in the description below. It's a good resource, and you're missing out if you're not following it. But now, let's get right into the mindset we need to have. First point I want to make is in the market, you are never supposed to predict. Instead, just react to what the market gives you. I say this all of the time. The market is a storyteller, and our job as traders is to understand and react to the story that the market is telling us. We don't go to bed every night and try to predict what's going to be in the newspaper. Instead, we get the newspaper and we react to what's in the paper. Same thing with the market. When we wake up in the morning, we don't try to predict what's going to happen next. Instead, we just react to what the market gives us. It's a storyteller, and we have to react to the story that it's telling us. Now, a lot of traders fail because they have an ego. They think they are better than the market, and they think they could figure it out and predict 100% of the time, what's going to happen next. I'll give you this advice. Never think you know what the market's going to do next. Never ever think that. Instead, think when the market does X and I see Y, we're going to get Z as the result. Be open to reacting to any scenario the market presents. It presents an infinite amount of scenarios, opportunities, and possibilities, which in my opinion is the best thing about the market. So what I mean about this is, let's just go over the Facebook trade. So I posted this in the pre-market plan today. I said Facebook needs to respect this 325 supply, however, gapping up inside of it. If the market is strong and Facebook creates demand above it or slices through it in the 329 area, I am open to playing calls and seeing what's going to happen inside of the gap. So this is my pre-market plan. This is not trying to predict. This is just having levels of interest. And my goal and my job as a trader is to react to what the market does when we come up to my levels of interest. So for example, my levels are X and my job is to see Y, because when I see X and Y together, I know I'm going to get Z as a result, and the Z most likely is going to be profits if my analysis is correct. So in this case, we rallied, broke above the 329 level, and rallied about 4 or so points above the supply zone. We're now above it, so that becomes invalid. Now on the flip side, this is where being reactive helps you when you are incorrect. So this is an example on Amazon where this was also on the pre-market plan. We had demand at 3355, 3321. I'm interested in seeing if buyers are present. If the market's weak, I'm not too interested in it. So we opened up, and instead of trying to predict, saying, oh, we come into this demand zone and I'm going to play calls or I'm going to be bullish, that's the wrong approach. Instead, we wait and we react to what the market gives us. In this case, the market did not give us any present buyers at this demand zone, so it's no trade, and it would have prevented you from entering this position, which would have been a losing one, especially when we did not respect demand, sellers were aggressive, and buyers weren't showing up. So this is what I mean about being reactive instead of trying to predict. Trading gives us the most freedom. You can make so much money. It allows you to be free of your choice to buy, to sell, to see what you want to trade. A lot of traders sabotage their own freedom by trying to structure something which is unstructurable. It's unstructured, the market. There are tons of different opportunities, possibilities. It's like trying to solve a Rubik's Cube that can never be solved because there aren't enough matching colors. The market is unstructured. You cannot control the outcome. You cannot control what the market does. But the only thing you can control is yourself and your emotions. A lot of traders that I see which fail are ones that try to control the market, and they are ones that can't control themselves and their emotions. They get the best of themselves and they lose it all. The next thing you have to do is you have to define your edge, define your signals, and define your strategy. In the market, there should be no thing as guessing. You should not be hoping, and you shouldn't have a lack of confidence. I see a bunch of traders who fail because they can't define what their edge is. I ask them, what's your edge? Or what makes you money consistently in the long run? Or what are your signals? How do you trade? What's your strategy? And they can't give me a definitive answer on that. Those are the same traders that go into the market every day blindly. They guess what's going to happen next. They have hope. They're in a position and they hope it goes up or they hope it goes down, and they just, take a very big loss, or they don't have confidence and they don't enter positions because they don't have confidence. Now, these are easy things to fix, but the first thing I recommend doing is understanding what your edge is. Your edge is your system, which generates the only reason why you should enter a trade. For example, let's go over the S&P today. My edge, this is very broad. I'm going to just briefly get into it. My edge is price and volume, supply and demand, and trading with not a lot of emotions that are detrimental to my trading. For example, I want a long at demand, short at supply, maybe take profits at supply, short at demand. Also, breakouts, key level breakouts, as long as volume and price are agreeing with my analysis. So that's my edge. Just to briefly get into it, you have to figure out what your edge is. There's other little branches from the tree which stem off of, the big branch, and it all fits together like a puzzle piece. And I will say your emotions and what you think will happen next is not a good enough reason for you to enter. People see something going up, for example, in this Facebook trade right here, right? People see something going up. Obviously we had a plan to get long above 329, but someone will see something going up, for example, in this fourth candle right here. They'll enter off of no other reason than they think it's going up, and boom, they get destroyed. They stop out for a big loss. So if your decisions are made because you think something is going to happen next, or your decisions of a trade being put on is made based off of your emotions, that is not good enough, and I guarantee you are going to lose. You trade when your edge is present, you take the trade without hesitation, and you exit the trade without hesitation when you get your exit signals. If you have hesitation or you have a lack of confidence, you have no conviction in your trading, that just means you aren't trading with an edge, which is very simple to fix. If you don't have an edge, if you're watching this and you're agreeing with it, like, oh, he's explaining exactly what I'm going through, I don't have confidence, or I don't have an edge, I don't know what works for me. To fix this, you have to paper trade, you have to back test, and you have to collect data to figure out what works best for you. Also forward test it, go through your journal, see what doesn't work, see what does work, put the pieces together, and that's how you figure out your edge. If you need to question your system, you need to figure it out, conform different pieces, and put the puzzle together. Because when you put the puzzle together, you could read the picture better. When you read the picture better, you put better trades on. Because when you put good trades on, that means you are trading with an edge, and that gives you an upper advantage over your competition. I cannot stress how important this is for new traders watching this. If you are agreeing with it, please listen. Do not trade with real money, or at least heavy real money, going with your full account size if you do not have an edge. If you go into the market without confidence, with hesitation, without conviction, do not trade with heavy real money because you are prone to losing it all. Only trade with heavy money or real money in general if you have an edge. Like I said, for me, my edge is supply demand. Here's another example on AMD. We bounced perfectly off of this demand zone. We had the idea that buyers are factored in. This is a good area for us to get now. We have X at the demand zone. We have Y that price bounced off of it. Now we just need to find an entry signal. Then we get Z. And when we get Z, we get profits. This thing had a clean move off of this demand zone. Maybe when we broke the high. Maybe when volume started pouring in. And had a clean all-day rally and closed right at the supply zone, which could have been a good area to take profits along the way up on the whole rally this morning and afternoon. Nice volume. but this is my edge. This is what works for me. Another thing is you have to establish your level of aggressiveness. Know your trade-offs, know your opportunity costs. I see traders trading in different conditions with, let's just say, full account size, when these are conditions that they really should be a spectator versus being a participant. So know your level of aggressiveness. Know if you don't enter here, maybe my risk to reward gets skewed. Know your opportunity cost if you don't enter or you do enter. For example, let's just say we had an ideal entry, maybe at the break right here when volume started increasing, right? Our risk was very small. But let's just say we weren't aggressive. Let's just say we didn't enter. Let's just say we wanted to wait maybe for a better entry. We never got it, right? We started to rally up here. And now let's just say we enter all the way up here. Our opportunity cost of not entering down here costed us this $2 move right here that could have been increased of our reward. Now we're buying up here. Our risk to reward gets skewed. We pull back $1, and let's just say we bought up here. We're probably stopping out on this move down if you don't practice proper risk management. Now also, if you're buying up here, you should definitely be trading with smaller size than you would have down here where your risk was much smaller. For example, if I'm risking, let's just say $2 or $1.50, I could go in with 50 contracts down here, and maybe the most I'm going to lose is, I don't know, $3,000. Versus going with 50 contracts up here, my risk is all the way down here. Let's just hypothetically speak, say the market came down. Now I'm losing 10 grand on this trade because I went with the same level of aggressiveness where the risk to reward really wasn't in my favor, if that makes sense. So you also need to understand that be flexible with the market. Don't just sit in your chair all day long staring at the market and like a statue, just sitting there. The market's constantly throwing rocks at you. If you're not there to deflect it and take the rocks and throw it back, you are never going to put a solid trade on, and the market's just going to destroy you and deplete your account. Adapt to current market conditions, adjust your level of aggressiveness and how you trade your setups based off of the kind of conditions you are trading in. For example, the S&P today, right? Beautiful move off of demand. But if we were to trade this with the same level of aggressiveness as we would on something like AMD, where it made a clean move, had nice volume, clean follow through, right? Obvious interest in the market, we would have had a clean setup on this versus something like the S&P where we were extremely balanced. We were lacking volume, very, very low volume, low volatility, in agreement with that. That just shows not a lot of participation and not a lot of interest in the market. So you need to adapt to the conditions the market's throwing at you and adjust your level of aggressiveness and adjust how you trade based off of that. Different setups, different markets present different ways you need to trade in order to be successful. Some setups, larger size to be aggressive, higher percent chance of working out. And some setups, you need to do smaller size to test the waters. Maybe it has a lower chance of working out. There isn't a one size fits all in the market. Your goal is to be wrong as much as possible, but lose as little as possible, if that makes sense. So it's okay to be wrong, accept it. Just make sure you are losing as little as possible. And when you win as much as possible. Go into the market with a defensive mindset over offense. If you're on offense, throwing Hail Marys every possession, you're most likely going to get the ball intercepted. But if you play defense, you play conservatively, your account is slowly going to grow when you make the right decisions. And when you make the wrong decisions, it is not going to deplete as much as it would if you were to play offense. Also, always be a student to the market. The market is constantly evolving. It's adapting. For myself, I constantly seek to improve. I constantly seek to get better, learn new things depending on what the market's trying to teach me. I'm constantly looking ways to increase my size because if I increase the size, my profits are obviously going to increase, or new ways to trade based off of different conditions. Except there is no secret system, no secret indicators, no secret holy grail that works 100% of the time. How I trade does not work all the time. I take losses. I'm not sitting here saying, something works 100% of the time. The sooner you are to realize that, the sooner you are to accept different things and trade much better. You also need to accept you cannot avoid losses, protect your risk. This is probably a very key point here. Let me make this key. Before you enter a trade, define the worst thing that's going to happen to you. That's your risk. That's where your analysis is proven wrong on the chart. Understand that the best that could happen, which is your reward, has infinite possibilities. You have to set it up that your risk is defined, but your reward is undefined, meaning you're risking $10 to make $1,000,000. You know, that's exaggerated, but your risk is defined and your reward is undefined. Write down the traits. This is key. I don't want to put a member on spotlight here, but write down the traits you want to remove from your trading, which harm you more than benefit you, and then do everything to avoid the pain that it brings you and avoids you from having success. What I mean by this is this member right here, every day I see it every week, and I think it's great. He writes my list of things that I do that he shouldn't do as a trader to have a green day, and lists everything he shouldn't do. If you are struggling, I recommend doing this because this will help you do the things that you shouldn't do, the things that bring you pain, and the things that are stopping you from success. You talk about it and you don't do these things. So I find that pretty cool. He also says what he does do the best. So you want to write down the traits that you have to do to become a better trader. You know, go do my course videos, go do some of my YouTube videos, and just be honest with yourself and understanding what needs to get done in order for yourself to get better. Be honest with yourself. You also have to never think you're going to outsmart the market. You are not smarter than it. I'm not smarter than the market. Warren Buffett's not smarter than the market. Maybe that's an over-exaggeration, but don't take a trade because you want to make money, and also don't take a trade out of revenge. I see someone, right? Another perfect example. Let's just say we play calls off demand, right? We're long at 118.14 at the low. Let's say a trader sees that I just made, $5,000 on this position. He sees the market all the way up here. Because he had revenge, or because he missed the original entry, now he's buying all the way up here out of FOMO. He doesn't want to miss out. Not only is his risk to reward skewed, but maybe he stops out on this pullback. Obviously, this is a trade that probably would have worked out, but don't revenge trade. Do not take a trade out of revenge. Take it because of your edge. Market doesn't know you. It doesn't care about you or your feelings. It takes money from those who are the most patient and gives it to the ones, or it takes money from those who are the most impatient and gives it to the ones who are the most patient. It's not going to reward you just because you want to make money. You are in charge. Success doesn't just come to you. You're not going to wake up one day and be the best trader. I can guarantee it. It's not going to just snap and hit you. Success is going to happen because of you. What you do and what you don't do. You are in charge. Accept full responsibility. You have the power to take money out of the market, or you have the power to lose it all and give it to other participants who are outsmarting you and doing things that you should be doing. Instead, you're not doing it. You make all your decisions, you implement it, you engage in it, and you disengage in it. For me, trading is the best because not only does it give us the freedom, but it gives me complete control of my outcome. It's not like you're going to go work for a boss, work 9 to 5, and he's dictating how much you make every year. You're on salary, right? Trading gives me complete control. If I'm successful in trading, it's because of me. There's no external factors that dictate my results besides myself. And I will say, at first, it's a cold and uncomfortable feeling. It's like being alone in your own castle. That's why I created the Ameritrade community. So no one feels alone. It's very engaging. It's very active. Very good community. However, growth doesn't occur when there is comfort. Growth doesn't occur without risk. Meaning, if you don't have risk on the table, you're never going to grow. Complacency kills. And the best feeling is your self-control rewarding you based on the power of your own actions and the benefit of having your own edge and sticking with it. I can't explain the best feeling in trading when you wake up, you plan, you react, and you trade something that works for you, which is your edge, and you get compensated for it month after month. I know my edge is going to make me money, so every time I go against my edge, I lose. So I do everything to stick to my edge because I know I get compensated from it. I know I have control. I know I'm responsible for my outcomes, and I know I'm going to make money month after month if I stick with it and trade it. You also need to accept that you don't need to be a great trader in order to make money. You don't have to be perfect. I know really bad traders that make really good money. And I know really good traders that lose money. You don't have to be perfect. You just have to figure out what works for you. And that's pretty much it. So, I mean, I don't want to turn this into a rant. I could go on forever. I will say the psychology videos in the course are excellent, and I recommend all Investor Trade members go back and watch them. If you are new, check out the links in the description below. I offer a very in-depth and educational course that will come with access to the Discord at no extra cost. If you enjoyed this video, drop a like, comment any questions. But besides that, I think it's over. I'm going to end it. And yeah, peace out.